The FIX protocol, or Financial Information Exchange Protocol, is the electronic language used in bond trading. Unlike equities, where you just trade a stock symbol, bonds require more details, such as issuer, maturity, coupon, and currency. FIX messages allow traders and dealers to communicate all of these details in a standardized way. Let's walk through an example. A portfolio manager wants to buy $5 million worth of a U.S. Treasury bond that matures in December 2030 with a coupon rate of 3%. Step 1. The order management system sends a FIX message called a request for quote to a dealer. This message identifies the bond using its ISIN and specifies that the trader wants to buy $5 million in face value. Step 2. The dealer responds with a quote message, showing a bid price of $99.25 and an offer price of $99.30. Step 3. The portfolio manager decides to accept the offer. A new order single message is sent back through FIX, with the order to buy at $99.30. Step 4. The dealer executes the trade and sends an execution report. This confirms that the full $5 million has been bought at the offer price of $99.30. Step 5. Finally, a trade capture report is sent, which provides the complete booking details. This report is used by the back office for record keeping and settlement. All of these steps, from the request for quote to the dealer's response to the order, the fill, and the booking, happen electronically using the FIX protocol. This is how FIX brings efficiency and standardization to bond markets, which are otherwise fragmented and often over-the-counter. So in short, FIX is the backbone of electronic bond trading, just like it is in equities and options, but adapted to handle the unique details of fixed income instruments. If you found this explanation helpful, please like the video and subscribe to the channel for more clear and simple explanations of trading and finance.